Here is something that most people sitting at home right now genuinely believe to be true. That what goes into their bank account is their own private business. That when they deposit money, move money, or receive money, it stays between them and their bank. I understand why people believe that. It feels like it should be true. But in 2026, that assumption is not just wrong. It is the kind of wrong that is costing retirees thousands of dollars, triggering IRS examinations, and in some cases resulting in legal consequences for people who had absolutely no intention of doing anything improper. The IRS today has more access to your banking activity than at any other point in American history. And the 5 deposit mistakes I am going to walk you through in this video are being made by retirees every single week, quietly, innocently, and with no idea that what they are doing is being noticed. My name is Whitfield, and if you are watching this channel for the first time, I want you to hit that subscribe button right now before we go any further. The reason this channel exists is simple. The financial systems that affect retirees are complicated. They change constantly, and the people running them are not going to call you up and explain the rules. That is what we do here, every single week. So subscribe, because every video on this channel is designed to protect your money, your retirement, and your peace of mind. Now let us get into it, because every single one of these 5 mistakes is more common than you think, and at least one of them may be something you are doing right now without knowing it. Let us start by understanding something important about how the IRS monitors banking activity in 2026, because this has changed significantly over the past decade. The IRS does not sit and manually review every bank account in America. Instead, they operate through a system of automated reporting, a network of legal requirements that forces banks, financial institutions, and payment platforms to report certain transactions directly to the IRS without ever asking your permission. This is not new. The foundation of this system has been in place since the Bank Secrecy Act was passed back in 1970. But what has changed dramatically in recent years is the breadth of that reporting system, who is required to report, what they are required to report, and how quickly that information reaches the IRS's computer systems. Today, when something in your banking activity does not match what appears on your tax return, that mismatch can be flagged automatically. And for retirees on fixed incomes, a mismatch that a software algorithm flags as suspicious does not know your story. It does not know that the deposit was from selling your car, or a gift from your adult child, or money you moved between your own accounts. All it knows is that the numbers do not line up, and that is enough to open a door you really do not want opened. So let us talk about the first mistake, and I want to be very clear about this one because it surprises people more than any other. The first mistake is called structuring. Structuring is the act of breaking up cash deposits into amounts under $10,000, specifically to avoid triggering an automatic bank report. Here is where the surprise comes in. Most retirees who do this are not trying to hide illegal money. They heard somewhere, maybe from a neighbor or a family member, that banks have to report deposits over $10,000 to the government. And their instinct, completely naturally, is to think, well, I would rather not have the government involved, so I will just deposit $9,000 today and $9,000 next week. Problem solved. Except the problem is not solved. It has just become significantly worse, because structuring, regardless of whether the money is completely legitimate, is itself a federal crime under Title 31 of the United States Code, Section 5324. It does not matter that you earned every dollar legally. It does not matter that you paid taxes on it. The act of intentionally breaking up deposits to stay under the reporting threshold is what is illegal, and banks are specifically trained to identify this pattern. If a bank sees you making repeated deposits of $9,500 or $9,000 or $8,900 over a period of weeks, they are not only allowed to report it, they are required to. In 2016 alone, the IRS and the Department of Justice seized $43 million from approximately 600 depositors who were suspected of structuring. Many of those people were small business owners and retirees who had no criminal intent whatsoever. The lesson here is critical. If you have a large amount of cash to deposit, deposit it in full. Let the bank file whatever report it needs to file. A currency transaction report is not an accusation, it is a form. Filing one does not mean you are being investigated. It means the system is working the way it was designed to work, and you have nothing to worry about as long as your money is legitimate. The second mistake is related to the first, but it is different enough that it deserves its own explanation. This is the mistake of making large cash deposits without being able to document where the money came from. Banks are required by law to file a currency transaction report with the IRS for any single cash deposit that exceeds $10,000. This is automatic. Your bank does not have a choice in the matter, and neither do you. But here is what most people do not realize. The currency transaction report itself is not what causes problems. What causes problems is when the IRS looks at that report and then looks at your tax return, and the money you deposited does not appear to have a traceable, explainable source. Maybe you sold some old furniture or jewelry at a private sale. Maybe a friend or family member paid you back a large amount they had borrowed years ago. Maybe you withdrew cash from your own savings account at another bank and then redeposited it somewhere else. All of these are legitimate explanations. But if you cannot document them, if you have no receipt, no text message, no signed note, no bank record showing the withdrawal from the original account, then you are in a very difficult position if the IRS comes asking. The IRS uses a technique called bank deposit analysis, which means they take the total of all deposits in your bank account for the year and compare it to the income you reported on your tax return. Under a legal standard established in a federal court case called Holland versus United States, any deposits that exceed your reported income are presumed by the IRS to be unreported income. The burden of proof is on you to explain the difference, not on them to prove wrongdoing, on you to prove innocence. This is why documentation is not optional. Anytime you make a significant cash deposit, write yourself a note the same day. Keep a record of what it was for, where the money came from, and keep any supporting paperwork you have. This one habit can be the difference between a clean record and a months-long IRS examination. Now let us talk about the third mistake, and this one is becoming more common every single year as retirees increasingly use digital payment platforms to receive money. The mistake is depositing money from apps like Venmo, PayPal, Zelle, or Cash App and not reporting it properly on a tax return. This is an area where a lot of retirees have been caught off guard because the rules around digital payment reporting have tightened significantly in recent years. Payment processors are now required to issue a 1099-K form to anyone who receives payments above the annual reporting threshold. The IRS receives a copy of that 1099-K directly from the payment platform. So if your grandchild sends you money through Venmo to help with a medical bill, or if you sold something on Facebook Marketplace and received the payment through PayPal, or if friends in your social circle reimburse you for a dinner through Cash App, all of that activity is potentially being reported to the IRS. And here is the critical issue. The gross amount reported on a 1099-K does not automatically separate personal transfers from taxable income. The platform reports what it sees. If you receive $7,000 through PayPal over the course of a year, and 5 of it was a gift from your son, and 2 of it was from selling old items in your garage, the 1099-K may show the full amount without making that distinction. If you do not address that on your tax return and explain what the money actually was, the IRS's matching system sees income that was reported by a third party but not claimed on your return. That is an automatic mismatch, and it is one of the most common triggers for IRS correspondence letters that retirees receive today. The solution is straightforward. Keep a simple log of any money you receive through digital apps. Note whether it was a personal gift, a reimbursement, or actual income. Share that log with your tax preparer at the end of the year so they can account for it properly. And if you receive a 1099-K that includes amounts that should not be taxable, make sure your tax return reflects that clearly with the proper explanation. The fourth mistake is one that specifically affects retirees who are drawing down their retirement accounts, and it is a mistake that the IRS catches at an extraordinarily high rate because of how automated the matching process is. This is the mistake of taking distributions from an IRA, a 401k, or another retirement account and not reporting the distribution accurately on a tax return. Here is how the system works. When you take a distribution from a retirement account, the financial institution that manages that account sends you a form called a 1099-R. It shows the total amount distributed, how much, if any, federal tax was withheld, and how the distribution should be classified. The IRS receives an identical copy of that 1099-R directly from your financial institution. Their computer system then automatically checks whether the amounts on your 1099-R match what appears on your tax return. If you forgot to include the distribution, if you reported a different amount, or if you misclassified it in a way that changes the tax treatment, the system catches it. This is not a human being reviewing your return and making a judgment call. It is an automated match that happens within weeks of your return being processed. For retirees who take their first required minimum distribution, this is an especially common area for errors. Required minimum distributions must begin by a specific age, currently 73 for most people, and failure to take the correct amount results in a significant penalty. But even retirees who do take their distributions on time sometimes make errors in how those amounts are reported, particularly when they have multiple retirement accounts, when they rolled over a portion of a distribution to another account, or when a portion of the distribution was qualified charitable in nature. Any of those scenarios can create a reporting complexity that, if handled incorrectly, looks to the IRS like unreported income. Work with a tax professional every year that you take retirement account distributions, and make sure every 1099-R you receive is accounted for on your return, even if the amount was rolled over and is not actually taxable. The fifth mistake is one that ties everything together, and it is perhaps the one that is easiest to fall into without realizing it. This is the mistake of having total annual bank deposits that significantly exceed your reported income without being able to explain the difference. Think about a retiree named Dorothy. Dorothy is 71 years old and lives in Florida. She receives Social Security, a small pension, and she takes a modest distribution from her IRA every year. Her total reported income is around $48,000 annually, but throughout the year, several other things happened. She sold her car for $12,000 and deposited the check. Her daughter paid her back $8,000 she had loaned her 2 years earlier. She withdrew $15,000 from a savings account at a credit union she was closing and moved it into her main checking account. And she received several $1,000s through Venmo from various family members for holiday and birthday gifts. None of this income is necessarily taxable. Selling a personal use car at a loss is not a taxable event. Loan repayments are not income. Moving your own money between accounts is not income. Personal gifts are not income to the recipient. But if you add all of that up alongside Dorothy's regular income, the total deposits flowing into her bank account that year are dramatically higher than the $48,000 she reported on her return. If the IRS pulls her bank records and runs a deposit analysis, which they absolutely can do without her permission once an examination is opened, every single one of those deposits will need to be explained and documented. Dorothy is not a criminal. Dorothy did nothing wrong, but without proper documentation and a tax return that tells her full financial story clearly, she could spend months dealing with an IRS examination that disrupts her entire retirement. The bank deposit analysis technique is one of the most powerful tools the IRS uses in examinations, and it is specifically designed to catch the gap between what people deposit and what they report. The way to protect yourself is not to change what you do with your money, it is to document it, communicate it to your tax preparer, and make sure your tax return reflects your complete financial picture, even when many parts of that picture involve money that is not taxable. Now, I want to step back for a moment and address something that I think is going through the minds of a lot of people watching this right now. Some of you are probably thinking, I am just a retired person living on Social Security and a small pension. I am not a millionaire. I am not running a business. Why would the IRS bother with me? And I want to answer that honestly and directly. The IRS in 2026 is not just targeting wealthy taxpayers. Their automated systems do not make judgments about how much money you have. They compare numbers. They run matches. And when a match fails, when a 1099K shows income that was not on your return, or when a 1099-R amount does not match your reported distributions, or when your deposits are mathematically higher than your income, a flag gets generated. That flag does not know whether you are worth $10 million or whether you are living on a fixed income in a small apartment in Arizona. It is a software flag, and it moves the same regardless of your wealth level. The retirees who get examined are not always the ones who have the most money. They are often the ones who have the most unexplained discrepancies. And discrepancies can happen to anyone who is not keeping clean records. So here is what I want you to walk away from this video ready to do. Start keeping a simple deposit log. Anytime you put money into your bank account that does not come from your regular retirement income, Social Security, or pension, write it down. Date, amount, source, and whether it is taxable or non-taxable. This does not need to be complicated. A notebook, a simple spreadsheet, even a note on your phone. 5 minutes at the time of each deposit can save you hundreds of hours of stress if the IRS ever comes asking. The second thing I want you to do is talk to your tax preparer before the end of this year and make sure they know about every 1099-R, every 1099-K, every large cash deposit, and every transfer you have made between accounts. Your tax preparer can only work with the information you give them. If you do not tell them about the $12,000 car sale, it will not appear on your return. And if it is in your bank account, but not on your return, you now have a gap. And gaps are exactly what the IRS's systems are designed to find. If this is the first time you are watching Whitfield, I want to ask you a genuinely important question. Do you know someone in your life who is retired or getting close to retirement, who handles their banking the way most people do, without giving much thought to how it looks on paper? A parent, a sibling, a friend, a neighbor? Share this video with them today. Not because there is anything to panic about, but because the people who handle this stuff the right way are the ones who never have to deal with it at all. One share from you today could genuinely save someone else a significant amount of money and stress. And that is a pretty valuable thing to do for someone you care about. Before we close out, I want to hear from you in the comments. Which one of these 5 mistakes surprised you the most? Was it the structuring rule? The fact that breaking up deposits can actually be a federal crime even when the money is completely legitimate? Was it the digital payment platforms and the 1099-K? Or was it the bank deposit analysis technique? The idea that the IRS can look at your total deposits for the year and compare them against your reported income. Tell me which one caught you off guard. I read every comment on this channel, and your response genuinely helps me understand what topics matter most to the people watching. So drop it in the comments right now. There is a lot more coming on this channel that you are going to want to see. We are going right into Social Security next, specifically the mistakes that are quietly shrinking monthly checks for retirees who have no idea it is happening. That video is coming up, and if you are not subscribed yet, you are going to miss it. Hit that subscribe button right now, and I will see you in the next one. Take care of your money, take care of yourself, and remember, the best time to protect your retirement is before you ever need to.